The following program is intended as an educational program, not as investment advice or as a recommendation to buy, sell, or participate in any investment vehicle, product, offering, or strategy. Investment advisory services are offered through Turning Point Financial, a registered investment advisor. Any references to specific securities, investment vehicles, or strategies are intended only as examples, not as recommendations. All investments involve risk, including the possibility of losing money. What if your financial goals and your deepest convictions were perfectly in sync? Welcome to episode 113 of Money and Mission here on Holy Family Radio, WHYF AM 720, where each week we talk about wealth management built on a foundation of biblical wisdom and principles. I'm James Good.
And I am Eric Tero. You know, we're surrounded by so-called financial advice every day. But how much of that advice actually helps you become who God wants you to be? Well, today, we're going to bridge the gap between your bank account and your heart's calling.
And then we'll break down some financial headlines or news bits. Anyway.
What's goings on?
Hopefully with clarity and focus. But that's just the beginning. As always, partway through the show, we'll see if we can stump you with our Pennsylvania weekly trivia, and then we'll spend the rest of our time diving deep into principles and practical strategies that help you manage your wealth with a clear conscience and a kingdom focus.
That's right. But as every week, James, the news keeps on coming, and today is no different. Where would you like to start today?
Well, I'd actually like to start where we left off last week.
Where was that?
We were talking about how many hundreds of billions with a B, right, of dollars are being spent on artificial intelligence in today's world. And I don't remember the exact number, but it was over 700 billion, wasn't it?
Yes.
Yes.
That we're spending on AI, building that out, infrastructures, data center, all that investment.
All that investment. How much is 700 billion? I really, how much is $700 billion? Just to picture this, right? If you were using $100 bills only, this is rather incredible. If you were using $100 bills only, it would take 343 standard tractor trailers to legally haul $700 billion in physical $100 bills.
All loaded up on pallets.
Wow. A single U.S. bill weighs 1 gram.
Okay,
right.
1 gram.
Now, they all weigh the same. Even a $100 bill, a $1 bill, a $20 bill, they all weigh the same. But to make 700 billion using only $100 bills, you would need 7 billion individual notes, which weighs roughly 15.4 million pounds, 7,000 metric tons. Now, a tractor trailer, a standard 53-foot drive-in semi-trailer, has a maximum payload of 45,000 pounds. 45,000 pounds. So if you took 15.4 million pounds of cash,
what you can even capable of carrying.
That's right. And divided by 45,000 pounds per truck, that is 343 trucks.
That's just weight. I'm wondering the volume would even fit.
Yeah. I mean, could you see all those trucks stretched across like Route 80?
I hope they're on the way to my house.
That's right. This is a big number. And we are spending that on artificial intelligence.
Mm-hmm. That's a
which
big,
is just
number.
Yeah, data. Lots and lots of data. Remember the next time you just start texting to somebody saying, "Hey, how are you doing?" I mean, right. you're using data which is part of that 743 billion.
I mean, but a lot of people feel like we can't fall behind, right? What happens if China gets there first, or Russia, or what if we lag behind our competitors in
if
terms
somebody
of AI?
in China is able to text "thank you" more times than I am,
Well, not just texting. Talk about AI.
they're talking about artificial intelligence. Yeah,
If you use an AI tool to help you draft a response message to your text, then yes,
that's right. Yeah, that's
you'd
right.
be using it.
That's right. Please help me draft a response to Joe sending me a text that says, "Thank you for being on Holy Family Radio."
Yeah, more data used. Right?
More data used. That's right. All right. Well,
Mind-boggling.
mind-boggling. That's right. Just, think about that the next time you're looking at your investment portfolio statement. A lot of data. A lot of data. Well, we got a new Federal Reserve chairman this year. And
Kevin
of
Warsh.
course, Kevin Warsh replaced Jerome Powell. But Jerome Powell is still on the committee. Usually Federal Reserve chairmen, when they stop
Ride
being
off into
chairman,
the sunset.
yeah, they ride off. They don't ride off into the sunset. They
get shows on CNBC.
Yeah, that's right. They write books
Yeah.
and make speeches and get paid, buku bucks just to come out and spew more of the same. Right.
They turn into a pundit.
But Jerome Powell stayed on the committee. And so
Kind of brave. He's been taking flack for a while.
he has been taking flack.
He just decided to stay there.
he decided to stay there for whatever reason. I don't have an inside line on why. I just know that he did. But the point is that his influence is still there. And that probably contributes to what Kevin Warsh describes as, quote, a good family fight. When
Yeah, we talked about that a couple weeks ago, I think.
we did, yeah. Good family fight. Would you like to be a fly on the wall listening to that committee meeting?
I mean, but honestly, I hope they're not all in there just agreeing on the same thing. I hope they're chewing through these ideas and discussing the impact that would have on our country.
Well, for many, many years, decades, in fact, Federal Reserve decisions have been somewhat unanimous. So your wish for them sitting over there chewing through the issues?
Well, somewhat is not completely,
Well,
right? There should be people in there with other points of views. Or
Right.
why have a board at all?
why have a board at all? That's a very good question. But for decades, you have to ask yourself, how much did they really disagree on anything? Because they always came up with these unanimous decisions. But that's not happening anymore. And but now you've got so the Fed met this week, and they decided to hold rates steady.
That's right. No shocker.
No shocker. Was it a shocker?
I mean,
Well, he was not giving us forward guidance. Remember, he's not talking now.
Well, not shocker from him. I just meant from just looking at the lay of the land,
Just looking at the lay
seeing
of the
where
land.
inflation's at and where rates are at.
Well, but the issue is that people were still expecting, the Fed's going to cut.
yeah,
the
but they're
Fed's
not
gonna-
near their 2% target that they claimed a while back.
They're nowhere close to the.
Not even close. If anything,
If anything, 3% is now in the rearview mirror. That's right. But the headlines now, people are like the New York Times had an article that said Warsh's performance falls flat with markets as Fed holds rates steady. Falls flat.
And I see the other one says his credibility is in question
His credibility.
after holding.
Yeah.
What do you think? Does he deserve all that criticism that's coming his way, or?
Well, he'd probably face criticism no matter what he did.
Absolutely.
Yeah. So it's tough to tell. I don't know if he deserves it or not, but certainly there it is. So for now, at least, interest rates are staying the same.
Yep.
Or they have. So we really are watching, though, bond yields, right? Because if the Fed holds rates the same, but bond yields go up, then that means the market is actually driving where yields are at, not the Fed. And that's a really important point, because when rates get higher and it costs more for people to borrow money, for governments to borrow money, for companies to borrow money, if money is more expensive, then it's harder to get things done. And so stay tuned. Watch to see what is happening in bond yields, and we'll try to keep you posted here periodically.
Yes. And what
So,
goes on at the Fed?
The economy
So we got
slowed in the second quarter.
Not just for us. I see a couple stories here we have. I know we only got a little over 2 minutes, but looks like we have a story here about South Korea and what's going on with their market, and also news about our economy slowing a little bit slower than expected. You think they're kind of related? What do you think's going on there?
Well, the fact that our economy slowed a little bit more than expected. Remember, gross domestic product consists of businesses making investments.
Mm-hmm.
It consists of consumers spending,
right,
and
government
spending.
And more, that's a bigger piece.
It's almost half.
Mm-hmm.
So half of that number. Now, what's interesting is that if interest rates go up and the government has to also pay more for money, then potentially some of that government spending is not actually adding to economic growth.
It's just servicing debt.
It's just servicing
and
debt.
Getting new debt.
That's right.
Mm-hmm.
So to date, we've been able to run a larger and larger and larger debt pile, and it hasn't seemed to really impact economic growth. We'll see if that starts changing.
Just like if I'm spending more money on credit cards, I'm not making more money.
That's right.
Yeah.
But certainly another piece of economic growth is where consumers happen to be. Gas prices are pushing again.
Yes.
Right?
Conflict resuming.
That's right. Gas prices have been high, and that's what's being reported, or that's included in those numbers that are being reported. And the whole point of that is that if you're paying a lot more to fill your tank, then you're not spending money on other things.
Right.
Right? And if you're not
saving,
spending money,
you're not building up assets.
right. But we're talking about GDP transactions. So if you're spending money on gas, then you're not spending money for, you're buying less food, maybe. You're not taking that vacation. You're making your shoes last another year. It's at all these things that you're spending less on, and that translates into a slower economy.
Mm-hmm. You have to make some cuts somewhere.
That's right. So we'll see if that situation persists as well.
Well, we'll definitely keep an eye on it. But I think that should be it for the news this week. We're about out of time in this segment. We're going to take a quick break. You've been listening to Money and Mission here on Holy Family Radio, WHYF AM 720.
Welcome back to Money in Mission here on Holy Family Radio, WHYF AM 720, where each week we talk about wealth management built on a foundation of biblical wisdom and principles. I'm James Good.
And I am Eric Tero.
And we're in a different room over here.
We are.
At the Holy Family Radio studios. We're in a different room, and the mics here are sitting on the table.
And
James
Joe has a habit.
And I have a habit of hitting the table. It sounds like this, right? Boom. Did you hear that?
Oh yeah.
Did that? Yeah.
Yeah, we heard it.
It spiked the needle.
Okay.
Yeah.
All right. Well, all right. I'll try not to do that. I'll do it once more just for effect. Boom. Okay. So.
3 more.
All right. Okay. Joe's
You have some
like,
editing to
oh no. Anyway, we are talking about wealth management, not pounding tables or anything like that. But today, and I think we're going to talk about this next week as too, the anatomy of a market downturn.
Dun, 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 dun. And what does that mean? We hear about it, right? People are always worried, watching the news, or are we about to have a downturn, a crash? What do all those terms actually mean?
Yeah.
So let's help folks this episode.
Actually, I debated about whether anatomy was a good thing to put in a title, but whatever. We'll leave it there because anatomy means the construction of.
I was about to say structure.
The structure of, yeah. But there's so much more because really, yes, we got all these terms, but I think it's one thing to say, as we do at the beginning of all of our podcasts, that investments involve risk, including the possibility of losing money.
What? They can lose money?
Yes.
I thought it was like guaranteed to make billions.
No, of course, any investment involves the possibility of losing money.
Oh, my.
And the point is, when you structure your investments, you need to structure your own financial position in a way that enables you to get through inevitable fluctuations in the value of your assets.
Inevitable. That's a good word. Because
Inevitable.
It's going to happen.
It will happen.
Happened many times before.
Right. Now, the point is that it is one thing to talk about a drop in prices. Oh, yeah, the market may go down, right? Well, it probably will. See, in our business...
And if you look at a daily chart, I mean, it's going up and down all throughout the day.
All throughout the day, yeah. But, I mean, in our business, we're really not supposed to say things like always or never.
Never say that, no.
Never say... No, never. Never say never.
That's right.
Never say always. Right. But as far as I can tell, in 35 years that I've been in the business, the market has always gone up and down.
Mm-hmm.
Both. So those downward price moves happen. And if you are not positioned in your own financial plan, in your own wealth management, if you're not positioned to get through those downturns,
it can be rough.
It can be rough.
That's right.
Right. So especially if you're counting on your investments or the increase in the value of your investments in order to reach an important financial goal.
Mm-hmm.
Right. So in the book of Ecclesiastes, we read, no, it says, I'm paraphrasing here, but Ecclesiastes 11:2, right? The writer of Ecclesiastes admonishes us, divide your portion to 7 and even 8, because you don't know what evil may befall you in the land.
You made a good point earlier. It doesn't say which one's going to do better, this pick or that pick.
That's right.
It's just what evil may befall you.
That's right.
You don't know.
It doesn't say divide your portion to 7 or even 8, because some of those are more aggressive, and others are more conservative.
Right.
And you want to make sure to have conservative
Where
assets.
they fit in a style box.
Where they fit in a large value, right? Yeah. No, it doesn't say that. It says you don't know what evil may befall you.
Exactly.
So even those safe assets, the ones that feel safe, can have problems. And if you're not positioned to get through those problems, or if your portfolio is not structured to help you get through those problems, then you've got a problem.
A bigger problem.
A bigger problem, right. So prices, you have to remember that. We say if you don't take anything away else from our discussion here on this, remember that a drop in prices can create real problems if you're not able to get through that. Always do remember as well that the price of financial assets like stocks and bonds and commodities can diverge dramatically from the underlying value.
Mm-hmm.
And that means both ways. We'll probably talk about bubbles some.
Yeah, I think we should.
Yeah.
Some folks say we might be headed towards one. We can talk about some from the past.
Some people say we might be in a bubble.
Mm-hmm.
If you want to know what a bubble is, go buy, that bubble stuff where you got that little round thing that you blow on it.
Oh, you blow bubbles?
Yeah, you dip it in there and blow bubbles.
Yeah. It's
That's
the
a
oldest
bubble.
thing in the world, yeah.
That's
We all know
right.
that.
Watch to see
Or
how...
bubble gum.
Or bubble gum.
And that's why I always thought it was weird when they say, are we in a bubble, right? Because even when you start, it's anything just growing. That
Where
first...
you're blowing that bubble.
That's initially a
I was
bubble.
like, don't do that.
But they always mean right before it pops when they talk about it.
Right. Well, how big can it go? I mean, watch this person blowing this really, really super big bubble.
How much gum you got?
How much gum do you got? That's right.
It
always, so the stock market is not a piece of bubble gum, but you know what? These bubbles happen. And
There's
then
still a finite amount of resources.
boom, they pop.
That's right.
That's right. So prices of financial assets like stocks and bonds can diverge dramatically from the underlying value. But long-term investing benefits from distinguishing between the fundamental value and the enthusiasm that surrounds it.
Oh, I think they call that hype.
Hype.
Yeah, the
That's
hype.
right. Yeah. Well, we'll talk about some of that as we talk through the anatomy of a market downturn.
And I don't know if you have notes in here, but we had a recent example of one, right? The whole SpaceX thing. That was really hyped up. Everybody was excited. I was excited to see it happen.
SpaceX took off like a rocket.
It sure did, and it landed like its booster did in the ocean. They're still trying to figure things out.
Still trying to figure things out. That's right.
I seen they just got a big contract from the Pentagon, not to go back to the news, but
yeah, that's right.
So we'll see.
Yeah, we'll see. So what are some of these terms that you hear about when the market goes down? Some of the terms, pullback. Pullback.
Like reins on a horse. Pull it back a little.
Like it pulls back a little bit. Isn't there a nice way to say, look, I just got my investment statement and I'm down 5%.
Oh, that's a little pullback.
Oh, it's a pullback. You got that right. It's a pullback. What happens? Suppose you get your statement, you're down.
And that means 5%? Yeah.
Oh,
okay.
What if you're down 10%? Or, the market goes down 10. You see the headline, it goes, oops, the market's down 10%. And, it doesn't really impact you unless, when you get your statement.
Now, sometimes impacting you.
That's right. Sometimes people say, well, I don't look at my statements. Well, it doesn't change the fact that you're down 10%. If you are. Maybe you're not. But a correction, so a pullback is when the market is down 5%, and then a correction is when a drop in prices of about 10%.
Gotcha.
So you have a pullback and a correction.
So what if it drops even more?
Well, then, like how far? 20%?
Yeah,
that
sure.
would be a bear market.
Anything over 20, they consider a bear market.
Bear market.
Okay.
Right. Now, a bear market can kind of last for a little period of time, although it doesn't feel very little or very short when you're the one sitting there going, I'm down 20%.
My stocks are hibernating.
That's right. That's a bear. I see what you did there. Then if it goes on longer, then you have an extended bear market.
I think someone just made that one up.
Well, instead of lasting...
That one's not as cool.
Extended bear market. Then instead of being down for like 20% for several months, an extended bear market may continue for months, many months, sometimes like, years.
Even like after the housing crash, I think it took like 3 or 4 years for folks to come back even again.
Yeah, but think the S&P 500 index and the NASDAQ from the year 2000 up through 2003. For 3 years in a row, those indexes were down.
Yeah, it's another one. That's the dot-com bubble, I guess, from that.
That's right. Think the 1970s when for 10 years the market went up and down, but basically sideways. It went nowhere at all. Nobody was really making money in the market in the 70s. That's right, the Japanese market, the Nikkei. The Nikkei 225 is Japan's version of the S&P 500. In 1989, it peaked out at 39,000, and then it declined more than 80%. That's not even on the numbers we talked about here. That would be a bear market times 4.
It says it took decades to recover.
It does. It did take. So
imagine you're about to walk into retirement when that happens.
Yeah. That is just bad news, right? So the point is that investments do not go up in value all the time. Sometimes they go down, and sometimes they go down a lot. And if you're not positioned to get through that kind of volatility, then you have a real problem on your hands. So we're going to talk about that more as we go through.
And next week.
That's right.
So we'll make it a 2-part episode,
that's
at
right.
least.
That's right. So stay tuned on this joyful topic.
That's right. Well, I think we're about out of time in this segment. It's time for us to switch gears.
It's time for PA Trivia. PA Trivia.
It's time for my favorite part of the show.
Which is?
Our weekly trivia.
Yes.
Pennsylvania trivia. Last week's question, in 1904, a long time ago, a pharmacist in Latrobe, Pennsylvania, invented a classic ice cream dessert that eventually became a global favorite. What is it?
Yum, yum.
Yum, yum.
Do you know, Joe?
I didn't know. You guys told me.
Oh,
Remember,
yeah,
I
you
tried
thought
to
it was
guess
the
last week.
Sunday.
I thought it was a Sunday,
Yeah.
Sunday.
but it wasn't it.
No, it was a Saturday.
Yeah.
No, no, it was.
That's better than a trivia.
A banana split.
Which I like, and you said you don't really.
I
right?
don't. No, I don't like banana splits.
Yeah, there are some places where you can bring your own banana,
Oh.
and they'll make it for you.
Do you get to save money?
I think that's how it works.
Okay.
Yeah.
Yeah.
BYOB. It's bring your own banana. Yeah.
That's right.
Alrighty. So this week's in 1861, a baker in Lidditz, Pennsylvania, opened the first commercial bakery in the United States, dedicating to making what popular salty snack? To reiterate, in 1861, a baker locally in Lidditz, Pennsylvania, opened the nation's first commercial bakery, dedicated to making which popular snack?
If you think you know the answer, send your answer to radiopuzzle@wealthdevelopmentcouncil.com, and we'll read the answer on the show next week.
We're going to take a quick break. You're listening to Money and Mission on Holy Family Radio, WHYF AM 720.
Welcome back to Money and Mission here on Holy Family Radio, WHYF AM 720, where each week we talk about wealth management built on a foundation of biblical wisdom and principles. I'm James Good.
And I am Eric Tero.
And we are talking...
Awesome.
We're awesome.
But we're also talking
right.
about...
We're in the same room
That's-
here for this segment as we were in the last segment, and it's the same table. Do not hit the table.
Remind yourself, James.
That's right. You know, that would sound like, a market downturn.
Ooh.
Right.
Hit it any harder, it could be a correction.
That's right. But, we spent some time in the previous segment talking about the fact that markets go down in value. And when markets go down in value, your investment statement goes down. The value of your investments go down.
Whether or not you cash it out yet or not,
Whether you cash it out or not,
that balance will show.
The balance will show that it went down. So investments do not always go up.
As I thought they did.
You didn't think that. You're just saying that.
I was hoping.
Yeah, that's right.
Wouldn't that be an easy radio show? Hi, everybody. Just buy more stuff today. It's going to go up.
It's going to go up. Yeah,
No
but
matter
it
what.
doesn't.
Nope.
That does not happen, right? So extended bear markets remind us that markets move in long cycles
Yes.
as opposed to straight lines.
Up and down.
That's right. Now, periods of prolonged pessimism, that's where investors don't feel good about the markets. Often sow seeds for future opportunities. That's not a promise, but it often happens that way by reducing excessive valuations. And we'll talk more about that.
Kind of like what Warren Buffett did. You go
Kinda like
around with
Warren-
a bunch of cash and down markets and
That's
buy
right.
up these companies he thought had potential.
That's right. And when things get cheaper and cheaper, that means it's going down. A lot of people, if you're holding that, you're losing money.
That's right.
So whatever it is, the asset is going down and down and down in value. At some point, it gets so cheap that investors are saying, oh, I'll buy some of that.
And people on the other side of the coin are like, I just got to get out of this. Mm-hmm. Well,
That's exactly
I'm
right.
losing my shirt here.
That's right. But because market fluctuations are real, you can lose money even if a longer-term trend is in place. And that's why it's important for you to be positioned in a way that you can get through some of those fluctuations. And having a plan, really we need to think about Christian stewardship and how that plays out in portfolio
And what type
management.
of principles can we look back to?
That's right. That's right. So let's unpack that. But for now, I think immediately let's talk about the emotional and behavioral traps, right? And what leads to a bear market is what leads to a bear market is that people just kind of feeling bad about where the market is, or are there true economics?
Honestly, I can see it being a little bit of both.
It is. Yeah.
Because not all these decisions are financial. A lot of it's emotional, too, with investors.
That's right.
And where they're at in life.
That's right. So, yeah, the answer is both. But someone said once that economics might light a fire, but investor psychology determines how long the fire burns.
They keep throwing wood on it.
Yeah. And because,
Just like when you
because the more that people are like, I'm out selling, right? It creates more selling pressure.
Just like headline news. You wake up, you see an article, something bad. Maybe fundamentals sparked that news, but now everyone reading that, getting that fear selling off.
That's right. Yeah. So famous investors like Charles Dow, Benjamin Graham, John Templeton, Warren Buffett, they all arrived at a very similar conclusion, just from slightly different perspectives. They basically concluded that economics is what determines what a business or a stock is worth. Economics. But psychology determines what investors are willing to pay. The business may be worth X, but sometimes people are willing to pay a lot more than what the business is worth because of the way they feel. And other times they're not willing to pay a fraction of what it's worth because of how they feel. And I would add that financial capacity determines what investors are able to pay for those businesses at any given moment, whether they feel like it or not. Right? Because you could feel like buying a big, beautiful house, but if you don't have the money,
it might be worth it. You might want to.
You might want to, but if you don't have the money,
it ain't happening.
That's right. So economics determines what businesses are worth. Psychology determines how much people are willing to pay, and financial capacity determines what investors are able to pay for that. So what kinds of economic deterioration might start the process of a market downturn?
Oh, well, I would say just too much debt on the books. That's always my biggie.
Too much debt on the books.
Absolutely.
I mean, that's kind of out there right now, isn't it?
Yes, it is.
Did we hit 40 trillion net international debt?
No, 39.7.
39.7.
I think we're at. We looked this morning.
It was just a couple months ago that it was.
We're going to be at 39 by June or July. Here it is, July.
And we're almost at 40.
Right.
Excessive debt. Well, rising interest rates.
Yeah, we went through that heavily in 2022.
That's right. Well, rising rates sometimes creates a condition for deterioration in the stock market, because if rates rise, you're getting more and more interest just for putting your money
much safer
at
over
interest.
here,
Yeah,
right?
You're not getting fluctuation in the value of your money, and you're getting more interest. So that reduces demand for those other assets. Falling corporate earnings.
Oh.
Right. Investors like to spend money on investments when the companies they invest in are making money.
And we've been hearing lately a lot of big companies are missing earnings. IBM was a big example.
That's right. Banking problems. Okay. Right.
Yeah, was that Community Bank?
We shouldn't be laughing. Right? It's not funny, right? But banking problems create problems, and it's one of the things that leads sometimes to extended bear markets. Asset bubbles bursting.
Pop.
Pop. Yeah, like that bubble gum. Productivity slowing down. Major geopolitical disruptions.
Like wars.
Like a war.
Yeah, things like that.
A war, that causes oil prices to go up.
All this rings home, doesn't it, Jeff?
It does. Anyway, these are problems. These are real economic problems that lead to markets, becoming volatile, having pullbacks.
And if
having
everyone knows
corrections.
this, why do you think it's so hard to correct the ship? Just too many conflicting interests, I guess. Because if it's that easy, cut and dry, why aren't we just cleaning it up?
That question is not in the script.
No, it's not. We probably need a whole show for it.
We do.
To be honest.
That's right.
It's
so
just
I'm going to
frustrating.
pretend you didn't answer that question.
I think it's just too much conflicting interest.
Yeah. It could be, but
because I forget who said it, but you don't need a conspiracy when interests align.
Right.
So when you see things going a certain way, it's like, well, what's driving that?
Right. Well, investor psychology drives.
Touche.
This is a
Bring
big
it back
deal.
on point.
That's right. This is a really big deal that the economic reality happens, and at first nobody really pays attention. Initially nobody pays attention until the end of the month when they get their brokerage account statement. But maybe you have a mutual fund portfolio and you don't get your statements until the end of the quarter. Now, people are getting statements at the end of the quarter from their brokerage account and from their mutual funds. So more people notice. And maybe somebody is thinking, oh my goodness, look what's happening. Oh, I'm out. I'm selling, right? Moving my money to someplace safer. And everyone has a different threshold at which they would do that. Just pull the trigger. I'm done.
Yep.
That is psychology. A psychological pain of losing $1,000 is twice as impactful as the joy of making $1,000. I don't know why that is. It just seems that we tend to remember bad things more than we remember good things. So, and then the headline trap, of course. I'm sitting here looking at my phone. I could scroll through and look at all these bad news things going on. And everybody sees those same headlines and they're like, I'm out of here. The world's going to end tomorrow, isn't it? Or maybe not tomorrow.
But if you are glued to the news, that's what you see.
That's right. Or maybe you see, some commentator saying the world is going to end on August 23rd. I'm sorry, I pounded the table.
Yes.
But you didn't hear
It
that.
wasn't bad.
It wasn't bad. It wasn't like that. Okay.
Joe giving the stink eye.
That's right. So the headline trap, but this feeds it feeds people's fear, and then people start making decisions. So especially if there was a pullback or a correction or something real that happened.
Bear market.
That's right. Something real happened, real economic news. And then all the psychology started. First of all, people are in denial.
Yeah, right.
That didn't really happen.
Well, first they don't know. They don't know about it at first.
They don't know about it,
and then
first.
they catch wind, and they're like, "Wait, nuh-uh."
And then the statement comes through, and they're like, "No, that is not possible, right?" And so, as many bad things, they're going to sleep on it overnight, and the next morning,
then they're going to wake up at 2:30
and look at the same statement and say,
Sweating.
"No, that number was real. That number was real." Okay, so they're. And then it's like, what's happening to my money? Fear, right? So denial, and then fear, and then I need to get out now, panic, and then despair. Oh no, what did I just do? Or maybe apathy. So anyways, behavior changes dramatically. Instead of asking, what is that business really worth? Like the stock of a big company. People are asking instead, how much more can I lose? And so they start acting on emotions instead of following the plan that they may have laid out.
Right. If they had a plan at all.
So from a stewardship perspective, bear markets, down markets remind us that fear and greed have always influenced financial markets. Scripture repeatedly warns against both complacency when there's prosperity going on and panic in adversity, right? A disciplined investor seeks wisdom rather than emotional reactions, recognizing that markets reflect not only business fundamentals, but the hopes and fears of millions of participants.
Well, we're going to take a quick break, and when we come back, let's take a look at some of those market bubbles and what we can keep an eye on in the future. You're listening to Money and Mission here on Holy Family Radio.
Welcome back to Money and Mission here on Holy Family Radio, WHYF, AM 720, where each week we talk about wealth management built on a foundation of biblical wisdom and principles. I'm James Good.
And I am Eric Tero.
And we are talking today about downturns in the market.
That's right.
Whether they're pullbacks or corrections.
Bear markets.
Bear markets.
Or
extended bear market. Yeah, that's right. The bear,
my least favorite.
That's right. The bear is out for a long time. So, this is what happens when the market goes down, which means that your investment value went down.
Don't think it's not going to happen.
That's right. Don't think it's. I know you think it never will, but it does. That's right.
I learned today that it sure does.
It sure does. You learned something new today. That's right. We'll call our compliance officer and say, "Hey,
Hey, Dane."
That's right. Do the markets ever go down? Yes. Okay. Sometimes.
I need to send an email to my clients.
Yeah, that's right. So, but these corrections, this happens, and then. A correction, the market pulls back, and that's because there's this trend. So you're looking at things are generally going up, but along the way, the market, the price, it just doesn't go straight up, right? And it kind of comes down a little bit, and then the trend continues, and maybe it comes down a little bit more, and then the trend continues, and people get used to the fact that it goes up.
And that's why they call it like a trend, right? Not just like a straight line.
That's right.
It's trending up. It's not perfect up.
It's not a perfect
up. It's a trend.
Yeah, it's a trend. Mm-hmm. But there are some things that happen along the way, like, big crashes, for example, like 2008. But these are called bubbles. I love it.
Not a sound effect.
I need to try that. Okay. How good am I, right? Don't pound the table, he said. So we made bubble noises instead, right? But an asset bubble, that's
harder than being a teacher, isn't it?
So a bubble is probably even worse than a pullback.
Oh, for sure.
Or what is a bubble? That's where everything, the bubble pops.
That's the dangerous part. Everyone's making money in the whole first 90% of that bubble.
That's right.
That's the sad part of it.
That's
right. Everyone's going and going and going, and then early adopters, and we talked about that.
The early adopters start making money, and then gradually more and more people are making money. And
then you got the late bloomers coming in.
Late bloomers. Speaking of bloomers. Speaking of bloomers.
Oh, a segue.
Oh, it was a segue. You could not have practiced that right. So, we were thinking, what is an example of a bubble?
And then James mentioned tulip mania. I was like, what?
Tulip mania. So, apparently, back in the late 1500s and the early 1600s, tulips became a deal. Tulips became
a big deal.
A big deal. Now, tulips were not native to the Netherlands, which is where Holland was located. Tulips originated apparently in Central Asia, and they became popular in the Ottoman Empire when tulips were gradually, dispensed around the world, before being introduced to Western Europe in the late 1500s. I love tulips. I can't imagine a world without tulips, but apparently back then, tulips
was one.
That's right. There was a world in which tulips were not all over the place. So, anyway, there it was in Holland in the late 1500s and early 1600s. And as tulips got spread around, apparently they became a luxury item because they're just beautiful flowers, right?
They are pretty. I like your picture there.
Yeah. And at the time, they were not very widespread, and so they were rare. There was not very much supply of tulips. Everybody started to want them, but it was difficult to grow them, to cultivate them.
Not the right climate out there.
That's right. And so this tulip, this flower, started to become a status symbol among wealthy people, especially wealthy merchants. Be like, wow, I love your flowers.
Where'd you get your tulip?
Where did you get your tulips? That's right.
You nerd.
And so, but see, this happens, right? This is how bubbles get started. Somebody has something and other people are looking at it saying, oh, I wish I could get that.
That's
right?
all the hype?
That's right.
Like
the camper I got a couple weeks ago. And then you saw the camper and you were like, man, I want one of those too.
I really
want a camper. And Joe's like, oh, I would love a camper too.
We should all go camping.
Everybody would like a camper, but they only have one out there. No, I mean, there's plenty of campers. So
James got it.
that's right. I got it. That's right. So
James got the good one.
I know.
Yeah, that's right.
Leaving me and Joe with the leftovers.
That's right.
all right, but tulips anyway. So so this is, and we're
You don't
talking
want to
about.
talk about it.
I don't want to move on to a different topic, right? But this is how financial bubbles take place, right? And this is how people lose lots of money.
So way back in the day.
Back in the day, the Dutch Republic was just entering its golden age.
And tulips were all the hype. From
Trade
Asia.
and shipping and finance, and the Dutch Empire was expanding rapidly.
Mm-hmm.
And so people had money to spend. And they began to
Why not buy some tulips?
buy tulips. That's right. And
Makes perfect sense.
makes perfect sense, right? So the tulip demand by the time that this started to happen, again, supply, remember, was pretty limited, and so soon collectors, scarcity fueled prices. The prices started going up because there was more demand
And what people are willing to buy, like you said
willing
earlier.
to buy,
Yeah.
and had the ability,
Capacity.
They had the capacity, and the psychology was there. I mean, they wanted tulips, and so
All the formula, pieces of the formula.
that's
were
right.
there.
And then the human condition kicks in. People wanted more, and the scarcity fueled the desire. I gotta have a tulip. Okay. So
Like Beanie Babies.
that's right. So this is the basic economic principle that scarcity plus rising demand often leads to rapidly increasing prices. It really doesn't matter what the thing is.
And when you inject more money to the system, aka more capacity and
inflation
then people
price
are going to want more.
goes higher and higher.
More bills to compete with.
That's right. So, and you have to remember this, right? Because when you see something, the price is just going up, you got to be careful. So, doesn't mean you can't make money in it, but you have to be careful. So, as prices climbed in this tulip market, buyers increasingly started entering the market not to grow tulips, but so they could buy the tulips and turn around and sell them at a higher price.
Arbitrage.
Yeah. I mean, Joe's sitting over there going, oh, I would like a tulip, and I'm going to buy my tulips from you.
Fresh off the ship.
And now I'm calling Joe. Hey, Joe, I got some tulips. And Joe's like, cool, because I'm going to sell them to the next Joe, right?
Exactly.
Exactly right.
He's going to get his cut too.
And so the price continued to escalate more and more quickly. So this brings up a great question. At what point does investing become speculation? And is speculation inherently harmful, or does it actually serve a useful purpose? I mean, it made me rich because it made you rich.
Game,
That's
yeah.
right. Now Joe's on the long end of the stick on that one. It's like the game of hot potatoes, right?
The consumer's the one that always gets the short end, right?
The tail end of that.
Yeah.
That's right.
And you're closer to them.
Yeah.
Yep.
Yeah. So something interesting started to happen back in this tulip story, that the tulip market became even more speculative because people started to write contracts on how much they thought the tulips were going to be worth in the future.
They had future tulip futures?
Tulip futures. And the contracts would change hands multiple times.
Oh, imagine a frost coming through the field and just wiping out all the time.
Yeah.
Oof.
And honestly, as I understand history, many of those traders never intended to actually take a tulip bulb. They just were trading the paper back and forth. So people with relatively little money started being able to participate in this upward price movement. Boy, doesn't that sound familiar?
Wow. So they were trading futures, not
They
rights.
were that's right. So the market
That's interesting.
became it increasingly revolved around paper claims rather than physical flowers. I mean, some of those people who were trading paper never saw a tulip. I possibly didn't even know what a tulip
But they heard the hype.
was. That's right.
Everyone was talking about it.
That's right. So this actually does it resembles today's trading of derivatives and futures and options
And IPOs even.
IPOs. Okay. That's right.
I stirred them
All
up
right.
a little bit.
Okay, so the bubble then began to accelerate. By the winter of 1636 to 1637, the price of tulips was rising almost daily. Stories spread of fortunes being made overnight because, why? I got my tulips. Yay. Okay. And participants came from many, many walks of life, right? There were merchants, skilled craftsmen, there were professionals, investors. I don't know if they had barbers back then, but from all walks of life. So popular.
It's like people now buying Bitcoin 400 years ago. They're speculating on tulips.
Tulips, that's right. So the point is that popular accounts claim that ordinary laborers sold their homes or life savings to buy tulips. So everybody got in on this. But in February 1637, I mean, common thoughts that happen when this goes on. People are thinking that price is always going to go up. Mm-hmm. I mean, if you think carefully, you can think probably about some stocks or different kinds of investments where you're thinking the price is always going to go up.
Or even if you don't think it's always going to go up, you're just fear of missing out on what everyone else is earning around you.
And you're also thinking to yourself, I know it's not always going to go up, but I'll be able to sell before it crashes. Yeah.
I'll time it.
Everyone else is making money. Yeah. So, I mean, there's something spiritual about this, right? Which we'll get to as we finish talking. But in February of 1637, apparently buyers, capacity ran out. Capacity to pay came to an end, and buyers failed to appear. No dramatic event happened. Instead, confidence in tulips simply started to disappear.
Mm-hmm. And that's a wild bubble.
That's right.
That's not the housing bubble or the .com bubble. I didn't even know that bubble existed.
That's right. And the bubble disappeared because confidence went away. And
that's a pretty good show.
Now
we went over a lot. What do you think about for next week?
Well, we'll talk about that next week. Stay tuned for more of the same.
I thought you were going to give him a little hint.
That's right. No, but we've seen how fear and panic can destroy hard-earned wealth. Understanding the problem is only half the battle. So next week we want to talk about...
No, we're not going to tell him until next week.
Okay. You're listening to Money and Mission.
On Holy Family Radio, WHYF, AM 720.